Hello, welcome to another OctaFX webinar. Today we're going to be talking about, or I'm going to be introducing you guys to technical analysis. And like in our previous webinar where we talked about candlesticks and how to read these candlesticks, today we're going to be looking at another aspect of technical analysis, which is chart patterns and indicators. My name is Ebuka Ambrose, and if this is your first time here, welcome. What we normally do at these webinars is we give you quality information on how to improve your trading skills as a trader. Now, before I go into the content of today's webinar, go ahead and type in the comment section your name and where you're joining us from. Type in the comment section your name and where you're joining us from. In the course of this training, if you have questions at any point, you can also type them in the comment section. I'll be checking to answer your questions. Okay. Simon, welcome Simon Olubenga from Ogun State. Welcome Kimani from Kenya, Christopher from Lagos, Elvis in South Africa, Olamilekan from Akure, welcome Ebenezer and Samuel from Lagos, Uche from Abuja, and Ozioma from Port Harcourt. Welcome. So before I go into chart patterns, I just want to give you guys a brief definition of technical analysis. Technical analysis is using historical price data to make trading decision. It could be chart patterns, it could be candlestick patterns, indicators, whatever. It's just basically trading with what you're seeing on the chart. And why is technical analysis important? Now, as a trader, if you can recognize chart patterns alongside the skill to apply these chart patterns in your decision making process, then you can increase your odds of anticipating where markets will move next. Now, don't get me wrong, the skill to interpret or the skill required to interpret these chart patterns correctly take practice and commitment to acquire. Okay, so we're going to be looking at the first thing for today, which is chart patterns. But before that, let me just welcome some of you guys. Matthew from Enugu, welcome. Ola Grace from Lagos, Ojo Samuel from Lagos, Samuel from Umaya, and Anne from Kenya, welcome. So straight up, we're going to look at chart patterns, right? What are chart patterns? Now, a chart pattern is a graphical presentation of price movement by using a series of trend lines or curves. Chart patterns are like the foundation of technical analysis. They are not bound by any scientific principle or physical law. Their effectiveness highly depends on the number of market participants paying attention to them, and they are caused by a number of factors, which includes human behavior. So chart patterns just simply gives you like a heads up about what the market is going to do or what the market is doing, right? We have two types of chart patterns. We have the continuation chart patterns and we have the reversal chart patterns. Now, the continuation chart pattern, just like the name goes, continuation, it helps traders identify opportunities to continue with the trend. Excuse me. And the most common continuation chart patterns include triangle patterns, flag patterns, and pennant patterns. While reversal, which as the name goes, reversal, is the direct opposite of a continuation pattern, which is used to look for opportunities to trade the reversal of a trend. Now, the reversal patterns seek to find where trends have ended. Common reversal patterns include the double tops and double bottoms, head and shoulder, and inverse head and shoulder patterns, and the triple top and the triple bottoms. Now, if you're just joining us, and you didn't get where I said, type in the comment section if you have questions. I'll constantly check the comment section to see if you have questions as we go on. Okay, so we're going to first talk about the continuation chart patterns. Like I explained earlier, the continuation chart patterns indicates that, after a chart pattern is formed and completed, the price is going to continue to move in the same direction that it was prior to the chart pattern. So if price was in an uptrend and this continuation chart pattern formed and completed, then price is going to continue in that initial uptrend. The continuation chart pattern is simply traded by waiting for a breakout and entering a buy or sell position in the breakout direction. So if price was initially in an uptrend and the continuation chart pattern is formed and completed, then you wait for a breakout to continue in the uptrend, which is the prior or the initial trend. If it was in a downtrend and the continuation chart pattern forms, you wait for breakout to continue in the downtrend, right? So in a continuation chart pattern, the breakout is in the same direction as the trend. Another important thing to note is that not every continuation chart pattern will result in a trend continuation. Some will result in trend reversal where price moves in the opposite direction of the current trend. Now, this is why it's important for you to wait for a breakout, right? For you to wait for a breakout so you can get confirmation. And it's also important that you don't trade these chart patterns in isolation. What do I mean? A chart pattern is formed, yes, but you don't just, if it's formed in an uptrend, you don't just continue the uptrend because it has been formed. You wait for confirmations like the candlestick. If it's an uptrend, then you wait to see some candlesticks that indicates rejection to the lower side. It could be a bullish hammer or a bullish pin bar, whatever indicates rejection to the lower side. You could use it as a confirmation, right? So we're going to look at the first type of continuation chart pattern. First type of continuation chart pattern, which is the flag chart pattern. The flag pattern occurs when a sharply trending price, let me see if I can. Yep, when a sharply trending price suddenly pauses and retraces in a rectangular range. It then breaks that range and continues in the original direction, giving you the opportunity to enter the second half of a trend at a better price than before the flag formed. Now, the easiest way to understand the illustration is to take this definition and just apply it to the illustration. Now, occurs when a sharply trending price, if you look at this illustration up here, you see that this price is on a sharp downtrend, right? And then price suddenly pauses and retraces slightly in a rectangular range. As you can see, it's retracing in a rectangular range. Then it breaks that range right here and continues in the original direction. Remember, this is a downtrend, meaning the original direction is going to be what? A downtrend. When you see patterns like this, I always tell you guys, don't just trade it in isolation. Don't hop on the sell, or if it's for a bullish flag pattern, don't just hop on the buy because it has formed, it's done with the rectangular formation, and then you're like, okay, this price is definitely going to go up. No, you wait for the chart pattern to be completely formed, and you also wait for confirmation candlesticks, right? You don't want to trade chart patterns in isolation. Second one we're going to look at is the triangle chart pattern, which is actually popular. So a triangle chart pattern involves price moving into a tighter and tighter range as time goes by and provides a visual display of a battle between bull and bears. A triangle pattern is generally considered to be forming when it includes at least 5 touches of support and resistance. Types of triangle chart patterns are the symmetrical triangle, which is a chart formation where the slope of the price highs and the slope of the price lows converge together to a point where it looks like a triangle. And the second one is the ascending triangle, which is a type of triangle chart pattern that occurs when there is a resistance level and the slope of higher lows. And the last triangle chart pattern, type of triangle chart pattern, is the descending triangle chart pattern, which includes a string of lower highs that forms the upper line, which can also call the resistance, and the lower line, which is the support level where the price cannot seem to break. So if you look at this chart pattern, type in the comment section if you know what this triangle chart pattern is. Remember, we have the ascending triangle chart pattern, the descending, and the symmetrical chart pattern. So let me know in the comment section what chart pattern or what triangle chart pattern this is right now. Okay, this is actually a symmetrical triangle. Now remember, the ascending triangle is a type of triangle chart pattern that occurs when there is a resistance level and a slope of higher lows. If you look at this one, you're going to see, like I told you guys in the previous webinar where I talked about trends, and I told you guys about higher highs and higher lows. If you look here, you're going to see that this is higher low, higher low, higher low, a slope of higher lows and the resistance level. So this is obviously ascending because it's moving upwards, right? And the descending triangle is quite the opposite, slope of lower highs with an area of support, and it's moving downwards. The symmetrical triangle is not like there is no straight resistance or support. It's just like if this were to be a battle between the buyers and the sellers, then it would be a draw. Neither the buyers or the sellers are pushing the price far enough to make a clear trend. But what normally happens after a triangle chart pattern is there is always a breakout. You see price going tight to this apex right here. There is always a breakout. That's what normally happens after a triangle chart pattern is being formed. It could be symmetrical, ascending or descending. There is always a breakout. Now you should, if you're trading triangle chart patterns, you should wait for the pattern to completely form and wait for the breakout. You could also wait for a retest and rejection if it's an uptrend and an ascending triangle is being formed. You can also wait for a retest and you see some indication that lower prices have been rejected, and then you can see that as a confirmation for you to buy. Okay, ascending chart. Okay, you guys are just answering right now. Well, I've explained, so we're going to move to the keynotes when trading triangle chart patterns. Now the first one is always take note of the direction of the trend prior to the consolidation period. Now remember, triangle chart patterns are continuation patterns, right? So you should always take note of the trend prior to the formation of this chart pattern, which is this is an uptrend, right? And the chart pattern is being formed. So because a triangle chart pattern is a continuation pattern, you should be looking for a breakout to the top side. But you shouldn't enter the trade unless the breakout has happened, price has closed above the resistance level, and then you're seeing confirmation candlesticks that indicate rejection to the lower or rejection to lower prices. The second one is make use of upper and lower trend lines to help identify which triangle pattern is being formed. Like I said in the previous webinar, I told you guys about how to use trend lines and determine, uptrends or downtrends. So these lines that you see here are actually trend lines. So you're going to make use of your trend lines to help you identify which triangle pattern is being formed. Now the third one is use the length from the flag poles to forecast appropriate target levels. What I mean by flagpole is this. So this ascending triangle pattern looks like a flag, right? And it has a pole. So you can use the length from here to here to determine your take profit level from here to here, or this, just like you have this from here to here. You can use it to determine your take profit level from here to here. And lastly, adhere to proper risk management to reduce the risk of a false breakout and ensure a positive risk to reward ratio is maintained on all trades. This is a very important aspect of trading. Most times you could see potential winning trades, but it doesn't mean you should just go hard or risk everything that you have on that trade. You have to always put your risk in check, know how much you're risking and know how much you're profiting from a particular trade. Okay. Like I said, if you've got questions concerning anything I've taught in this webinar, you can type them in the comment section and I would answer your questions. On the next chart pattern we're going to be looking at is the pennant, and this is still under continuation chart patterns. Now the pennants are continuation chart patterns that are formed after strong moves. For example, after a big upward or downward move, buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. This causes the price to consolidate and forms a tiny symmetrical triangle, which is called a pennant. While the price is still consolidating, more buyers and sellers usually decide to jump in on the strong move, forcing the price to break out of the pennant formation. Now, like I said, the easiest way to understand these chart patterns is to just take this definition and apply it to what you see on the illustration. Now, pennants are continuation chart patterns that are being formed after a strong move. It could be a bullish pennant or a bearish pennant, but if you notice, it's being formed after this strong bullish trend, right? Or this strong bearish trend. So you can see that there are less sellers here, which indicates a strong bullish trend. And now price has decided to pause, like it says here, after a big upward or downward move. Buyers or sellers usually pause to catch their breath before taking the pair further in the same direction. Now, when you see patterns like this, like the pennant, the first thing you need to take note of is the initial trend prior to the formation of the pennant, because this is a continuation pattern, so you should be looking to continue with the trend. But like I always tell you guys, don't blindly trade this chart patterns on isolation. You need to have multiple confluences, which could range from your indicators to candlestick conformations. But yeah, don't trade any of these chart patterns alone, right? So while the price is consolidating, more buyers and sellers usually decide to jump in on the strong move, forcing the price to burst out of the pennant formation, just like you have here. Buyers have decided to take this trade out of this resistance and continue the uptrend. Same thing here. Take the trade out of the bearish pennant, out of the support level, and continue with the downtrend. The same way that you use the flag poles to determine your stop and your take profit levels is the same way you can still use it for the pennant. So you can use the same height from the flag pole to determine your target and your entry and your target levels and your stop levels. When I mean target levels, I'm talking about take profit levels. Now, when looking at a pennant continuation pattern, you're going to see a flagpole, you're going to see breakout levels, and you're going to see the pennant itself. If there is no flagpole, then it's not a pennant, it's a triangle pattern. So every pennant continuation chart pattern must have a flagpole. Okay, do you have questions concerning pennant before we move to the next continuation chart pattern? Okay. Another important thing to know about the pennants is that there are, like, the pennants are short-term patterns that are usually completed within 1 to 3 weeks, but a triangle pattern takes, a longer time, much longer time to form. So the pennant forms faster. Okay. We're going to be looking at the rectangle chart pattern, which is also a continuation chart pattern. Now the rectangle chart pattern is formed when price is bounded by a parallel support and resistance level. A rectangle displays a period of consolidation or indecision between buyers and sellers as they take turns throwing punches, but neither has taken control. When you see chart patterns like this, the first thing that you need to ask yourself is this a continuation pattern or a reversal pattern or a reversal chart pattern? Now, the rectangle chart pattern falls under a continuation pattern, so you're looking to continue with the initial trend before the rectangle pattern was formed, right? You can have bullish rectangle patterns and you can have bearish rectangle patterns. As you can see, it just keeps bouncing off at support and resistance, support and resistance, support and resistance, support and resistance. Now, none of the buyers or sellers are taking control at that point, but at the end of the day, price tends to break out and continues with the initial trend prior to the formation of the triangle, of the rectangle pattern. Sorry. So the price would test the support and resistance several times before eventually breaking out, and from there price would trend in the direction of the breakout, whether it is to the upside or to the downside. You just have to wait for one of these levels to be broken and then you go along for the ride. Okay, Christopher says, what is the appropriate time? What is the appropriate time frame to use in drawing these chart patterns? Chart patterns form in all time frames, right? It just depends. It depends on the kind of trader that you are. So if you're a day trader, then you should be looking for these time frames, for these chart patterns in the 1 hour time frame, 15 minutes, 5 minutes. But it doesn't mean you shouldn't go out to the higher time frames to see the initial trend. You can't do without the higher time frames. You need to know the initial trend. You need to know the trend from the higher time frame. Now, if you're a swing trader, then you should be looking for these chart patterns in the 4 hour time frame, the daily time frame, right? But these chart patterns form at all time frames. So there's no specific time frame that it doesn't form or it does form. But yeah, the same thing for the rectangle, for the bullish or bearish rectangle chart pattern. If you're getting your take profit levels or your target levels, you use the same height from the initial rectangle pattern to determine your take profit levels. Okay, there are different ways you can use to get your stop loss and take profit levels. You can also use, if it's a bearish rectangle pattern, you can also use previous support levels that price tested, and for the stop loss you can use the previous highs, the previous lower highs of the rectangle pattern or of the market. Okay, now we're going to talk about reversal chart patterns. Now, I explained continuation chart patterns and I told you guys that the continuation chart patterns shows you that price is coming from an uptrend or a downtrend, it has paused to continue in that uptrend or a downtrend. Now, the reversal chart pattern is the exact opposite of a continuation chart pattern. The reversal chart patterns are used to look for scenarios to trade the reversal of a trend. Reversal patterns are found where trends have ended. If a reversal chart pattern forms during an uptrend, it hints that the trend will reverse and that price will head down soon. If the reversal chart pattern forms in a downtrend, it's trying to tell you that the trend will reverse and the price would head up soon. We're going to look at the first. We're going to look at the first type of reversal chart pattern, and the first one is double top, which is very, very popular. Double top reversal chart pattern. Now, the double top is a chart pattern where the price reaches a high twice and fails to break out higher during the second attempt. The price reaches the first time and the second time, and it has failed to break out the second time, so it drops, it returns. The pattern comprises two peaks of nearly the same size and a bottom between them. The bottom is easily called the neckline, and the line running through the tops should be the resistance line. You can see this red line running through the tops. They must not be equal, but they should be, nearly horizontal. Now, the double top forms an M shape and is considered a bearish reversal chart pattern. Like I said, the new minor support level is called the neckline, and the pattern is confirmed once price breaches the low of the pullback between the two highs, which is here, the neckline. Where is the pullback? This is the pullback between the two highs. This is the first high and the second high. The pullback between is right here, and the pattern is confirmed once the price breaks or breaches the low of this pullback between the two highs. Let me give you guys with this example right here. So market tested, created a new resistance because it wasn't able to break this point, right? Pulled back and came to create a support level right here, and market went back to test the new high that was created, but it couldn't break it, right? So this is kind of like a strong resistance zone. When you're indicating this in your trading app platform, I prefer to use the rectangle tool, not lines, because most times markets may not respect the lines, but they respect zones, right? So tested at this point, couldn't close above, and it's returned to break below this support level, broke below the pullback between this first high and second high. So it broke below, and most traders would enter the breakout and set their stop loss probably above here, but I'll prefer to wait for a retest, and I'll see a rejection of higher prices, when price is not able to close above this support level, and I see some rejection of higher prices. It could be a shooting star or an evening star or a bearish pin bar. Whatever indicates rejection to higher prices can give me confirmation to sell this price. Now, for the target levels, like I said, you can still use the height from the high to the low and indicate your take profit levels. You can set your stop loss right above the previous high. Okay, so I'm just checking to see if you guys have questions and to know if I'm too fast or too slow. But yeah, no questions so far, so I would assume that it's pretty understandable, right? Yep, we're moving to double bottom. Double bottom is like the opposite of double top. As you have double top, you have double bottom. Now, a double bottom is a chart pattern where the price holds a low 2 times and fails to break down lower the second attempt, and instead continues higher. So, like I always tell you, the easiest way to understand these chart patterns is to take this definition and apply them to kind of overlay them to the illustration that you have right here. So double bottom is a chart pattern where the price holds a low 2 times. You have the first low and you have the second low, right? Holds a low 2 times and fails to break down lower during the second attempt. So price failed to break down lower right here, but instead it continued to break out from this resistance level, which is the neckline. Now the neckline of the double top is below, which is a support. The double bottom is the opposite, so the neckline is above and serves as a resistance. And this double bottom chart pattern is confirmed or is fully formed when price has broken out of this resistance level. Now it is considered a bullish reversal chart pattern since the price holds a low 2 times and eventually continues with a higher high, right? So you can choose to hop on the trade when you've noticed some rejection to lower prices from candlesticks. It could be a morning star, bullish pin bar, a hammer, whatever indicates rejection to lower prices. Just make sure that you don't trade these chart patterns in isolation. Don't just because you see that price is here, so you just want to buy because you assume that this is a double bottom and you just want to buy right here. No, you need confirmation, right? You need some confluences in the market, or you can wait for a retest and still look out for confirmation candlestick that indicates rejection to lower prices and ride the newly formed trend. Now for the take profit levels, the same thing. You take the height of this high to the low, to the 2 lows, and determine your target levels, or you can use previous resistance level that price has touched in the past and indicate and use them to identify or select or choose your take profit levels. Another reversal chart pattern, just like you have the double top, is the triple top. The triple top is a chart pattern that consists of 3 equal highs followed by a break below support. The chart pattern is categorized as a bearish reversal pattern, and the formation of the triple top indicates the existence of an uptrend which is currently in the process of reversing into a downtrend. Same thing, take the definition and overlay it on the illustration for easy understanding, right? So triple top consists of 3 equal highs, 1, 2, 3. Now in real market condition, they must not be really equal. Like you have this very equal straight line here. If you look at this one, it's not really equal like that, but one shouldn't be higher than the other. It should be almost equal, right? And then it's followed by a break below support. So you have the double top that price cannot break out from the resistance level twice, and then the double top is confirmed when the price has broken below the neckline. The triple top is the same thing, but then there is one last retest at the resistance that cannot be broken, and then price comes down to break the support level. The formation of the triple top indicates the existence of an uptrend. And let me use this for example purposes, right? This is an indication of an uptrend, right? But then the triple top is going to tell you that this uptrend is currently in the process of reversing into a downtrend. 1, 2, 3. Price broke out from support level and went straight down. Now I know I've told you guys about waiting for retest, but price doesn't always retest. So if you're looking to trade the initial breakout from these chart patterns, always put your risk in check and make sure that you're using a good amount of lot size, so you don't want to just risk everything. right? Um, the triple bottom is the opposite of the triple top. Okay, don't get confused. You have the double top, you have the double bottom, which is, you know, two lows, and you have the triple top, which price is trying to make, prices cannot break above the resistance, and price has formed three equal highs. And you have the triple bottom, right? Now the triple bottom is a chart pattern that consists of three equal lows followed by a break above resistance. Triple top, break above support, triple bottom, break above resistance. Now the chart pattern is categorized as a bullish reversal pattern, and the appearance of the triple bottom indicates the existence of a downtrend, which is currently in the process of reversing to an uptrend, just like you have here. So we're going to take the definition and just overlay it on the illustration. It's a pattern that consists of three equal lows. You have 1, 2, and 3, and it's followed by a break above resistance. And it's categorized as a bullish reversal pattern. Now, like I said, it doesn't always retest, right? These chart patterns don't always retest. So if you're looking to wait for a retest, you may have not, you'd have missed this trade. Okay, so yeah, the triple bottom indicates the initial existence of a downtrend, which is currently in the process of reversing to an uptrend. One thing about chart patterns is you have to wait for a complete formation and a breakout before you can decide. Don't assume that the market is going to do this. Confirm that these chart patterns have been formed already, and there's a breakout and there's a confirmation that you should enter the trade, which of course, while of course putting your risk in check. We're going to talk about head and shoulder. Here, okay, I'm trying to check for questions. Okay, Calvin says, when using the double or triple top or bottom, must you use indicators? The reason why people use indicators is so that you can have like enough confidence to place your trades, right? So you can get confirmation from chart pattern, from candlestick, and from your indicator. So it's giving you enough confidence to place your trade. I wouldn't really tell you that it's compulsory or it's mandatory for you to use indicators, but it just gives you an extra guide or an extra confidence level for you to place your trades. We're going to get to indicators later, so we're taking it one step at a time. Head and shoulder pattern. The head and shoulder pattern is a bearish reversal pattern that is described by three peaks. The outside two are close in height and the middle is the highest. So same thing we're going to do. Take the definition and overlay it on the illustration. It's described by three peaks. You have the left shoulder, first peak, head, second peak, and the right shoulder, which is the third peak. Now, the outside two are close in height. The left and the right shoulder, which is the outside two, are close in height. And the middle, which is the head, is the highest. Now, when you see a pattern like this, when a pattern like this is formed in the market, it indicates or it illustrates that the upward trend is coming to an end. Don't get me wrong, the head and shoulder pattern takes longer time to form. If you look at this candlestick, you could be getting up to 50 to 100 candlesticks, right? So it takes longer time to form, and you rarely see them in the market, to be honest. You rarely see them in the market, but yeah, it indicates that the upward trend is coming to an end. But then the reversal is confirmed when the price drops below the neckline, which is like the support level. So price drops below the neckline. Let me zoom this. Moving down past the previous low. So price broke out from this neckline and it has moved past. This is the previous low, and it has broken out and it has moved past that previous low. So you can confirm that the head and shoulder pattern or the head and shoulder pattern can be confirmed once price has broken this neckline and it has moved past the previous low, this previous low right here, this one. So broke out from the neckline, that's moving downwards past the previous low, and then you can confirm, okay, this is the head and shoulder pattern is totally formed, the breakout has happened, I should look to sell this market. And the inverse head and shoulder pattern is like the opposite, the same pattern, but then it's just inversed, right? It's similar to the standard head and shoulder pattern, except that it is inverted. Lysis says, how do one trade with the difference in the chart pattern? The main thing is just to understand the difference. I explained these chart patterns on this webinar. So what you should just do is understand what this chart pattern means, what the purpose of this chart pattern is, understand the next one and the next one and the next one, right? So when you see this one, you know that it means this. For example, if you see a bullish flag pattern, then you're obviously looking to continue with the uptrend, right? If you see a double bottom, then it's telling you that, okay, this uptrend is coming to, this downtrend is coming to an end, so market is trying to go to the upside, right? So these chart patterns have different purposes, and the way you can spot the differences by understanding their purpose. Okay, now we're going to talk about the inverse head and shoulder pattern. The same thing, just that it is inverted, and now your neckline is at a resistance level. An inverse head and shoulder pattern upon completion signals a bullish trend reversal. The head and shoulder pattern, the normal head and shoulder pattern upon completion signifies or indicates a bearish trend reversal, right? So it's confirmed when price has broken out from the resistance level, and this one has a retest, so you're seeing something that looks like a bullish pin bar that indicates rejection to lower prices. It's giving you an indication that you should go long on the market, on this pair, wherever it is, right? So you want to look for candlesticks that indicate or that is showing you rejection to lower prices at the retest, if there's a retest, so you can go long on the pair. So let me just do a quick recap. It has, the head and shoulder pattern has a left shoulder which is almost the same height as the right shoulder, and it has a head which is longer than the left and the right shoulder. The pattern is confirmed when price breaks the neckline, and the same thing goes for the inverse head and shoulder pattern. Okay, questions on inverse head and shoulder pattern? Okay, how to trade chart patterns. So this is like an approach to trading chart patterns with 3 easy and main steps. The first one is to decide on the time frame you want to trade. Now, as a day trader, when you close your trades within the day, you don't need to start placing or start doing your spotting or chart patterns on a daily time frame, because you're not going to, if you spot this chart patterns on a daily time frame, then you may not be able to close your trades that day, right? You can just use the daily time frame or the 4-hour time frame to determine the initial or the overall trend, but when you want to look for these chart patterns and place trades that you want to close within the day, then you should be looking at lower time frames from 1 hour to 5 minutes. And for the swing traders, you can look at the higher time frames, because you're used to keeping your trades running for days, weeks. So you should look out for these chart patterns formation on the higher time frame. Second one is to identify the main trend of your preferred time frame. Like I said, you need to identify the overall trend of your time frame. So if you're a day trader, you identify the overall trend of the 1 hour time frame or the 5 minutes time frame. Same thing goes for the swing traders. And then you can now spot your chart pattern. So once you see the dominant trend, you can now spot your chart patterns to time the market. And like I always tell you, you have to wait for these chart patterns to form completely and wait for a breakout. Because if you don't wait for the chart patterns to form and you trade based on assumption, then it could be that, for example, let's say for a double top or a triple top, let's say you feel like the market is, because let me go back to triple top. Yeah, so let's say the market has formed this, rejected here, pull back, rejected here, and came down here, and you're like, oh, this is a double top, let me hop on the sell right here so that I can start catching the sales before the breakout. Boom, goes back up, hits your stop loss or takes you out of the trade because it's trying to form a triple top, and then it comes down to breakout. So if you are just waited for a breakout, waited for confirmation, then you wouldn't have lost that trade. So you want to wait for these chart patterns to form before you can now trade the chart patterns. You also want to wait, you want to look for confirmations on candlesticks that will indicate the direction of the trend. Do not trade chart patterns in isolation. Okay, so that's it on chart patterns, continuation chart patterns, and reversal chart patterns. But before I move to indicators, type in the comment section what chart patterns you want me to use as an example right now. Let me know what chart patterns you guys want me to use as an example right now. Okay, Wagner says, if you identify a chart pattern, when do you place a trade? I can tell you guys, you place a trade when you have confirmation. It could be from your candlestick, actually candlestick confirmations. If price is in an uptrend and let's say a double top is about to form and price has broken out of the neckline. Let me not give you guys blind examples. Let me just go back to double top. Yeah, so price has broken out of the neckline. You have to see some rejections to higher prices. You have to see probably a shooting star or an evening star, you know, a candlestick that's going to indicate rejection to higher prices, especially when, you know, market is finding it difficult to close above this support level. Okay, I hope I've answered your question. Okay, so we're going to look at the first one we're going to look at is the head and shoulder pattern. As an example, on reversal patterns. So just okay, so this is euro, Aussie dollar, Australian dollar, euro, Aussie. So we have euro AUD on the 4-hour time frame, and let's say this market is on an uptrend, right? Obviously, series of higher highs and higher lows, and let's say we are just observing this market. So what just happened? Price has just created or indicated a support level. So we're just going to it's okay to use horizontal lines, but I prefer to use the rectangle tool because market moves in zones. It doesn't always come down to the exact horizontal line. But yeah, we have let me still put this because This was an initial area that price could not, break, and price has gone to create a new high. So I'm still going to respect this new high. Let me use a horizontal. Okay, right there. And what's happening is price has returned to the support level. It cannot break through. Like I said, this is why I use zones, because if I had used a line, then price may not have gotten to the specific line that I used. If you understand what's happening here, you can see that market or price has just formed a head and shoulder pattern. Boom, right there. So yes, this is a head and shoulder pattern. Let me give you guys another example. So if I was to assume that this is going to be a double top and I entered blindly without any confirmation, I would have lost this trade, right? This is why you need to get confirmations. It could be any candlestick that indicates rejection to higher price, right? And that close below the previous low, then it could be an indication that price is going to drop. But there's no indication here, so don't enter the trade. Now price has gone to completely form a head and shoulder pattern, but this doesn't mean I should just enter blindly, right? What am I looking for? I'm looking for a confirmation. Boom. If you look here, you see that you notice this bearish engulfing candlestick that has opened and closed below this bullish candle. That can serve as a confirmation for me, and I can be looking to hop on a short position right about here. Put my stop loss a little bit above the previous. Yep. And then for take profit levels, you can still use the height from the head to the support level. So let's say we're taking the same measurement from here, and then we apply it down here. This is like one of the ways you can use to determine your take profit levels. I can also decide to use previous levels that I can use here. I can use here because these are like previous levels the market has touched. So let me just go ahead and actually use this zone. Why I'm not coming down below is because this is just one touch, right? But here market has bounced up at this point so many times, so that can serve as my profit target level. And let's see what's going to happen in this market. You see how price has not closed yet, but it just tested, almost closed at the TP. And if you notice, these candlesticks they're just bouncing up. They don't go straight down to your take profit, which is one of the things that you'd experience as a trader. You have to be patient and let your trades work out for you. So boom, market has closed. Market has hit our take profit level, and we're out of the trade. How did we get this take profit level? The same height from the head to the neckline. Just applied it here. That's it. Or you can choose to use the previous strong zones in the market as your take profit levels. You can also use a 1-to-2 reward or risk to reward ratio, 1-to-3, depending on what your trading plan is like. So this is for reversal chart patterns. Let's talk about continuation chart pattern. Continuation chart pattern. Do you guys have any suggestion on what continuation chart pattern I should use, or do I just go ahead So what this says, the 15 minutes is to this is a 4-hour candlestick. This is not even 15 minutes. So okay, so let me just do one for a pattern that is rarely talked about, which is the rectangle chart pattern. So we're trading the dollar against the Canadian dollars, and as you can see, market is like on a downtrend, and what happens? Starts to consolidate, right? Creates this new low, and if you notice, market has just created a okay. Let's increase the speed a little bit. Yep. So at this point, what I'm going to do is to apply. Okay. So at this point, I'm just going to apply the same rectangle too. If you want to use a horizontal line, it's fine. But now we have a zone that is difficult for price to break, and we also have a resistance that has also proven difficult for price to break. Now remember, you're taking note of the initial trend prior to this consolidation downtrend, right? So whatever happens on this trade, I'm looking to continue with the downtrend, which is why you need to wait for breakouts. So if you look right at this point, you're going to see the market broke above but couldn't close above this zone. It just broke above to create that wick, but it couldn't close above that zone. But yeah, still bouncing and bouncing and bouncing. What are we expecting? Continuation of the initial down trend. Okay, boom, right there. Okay, so what happened? Price has broken out from the consolidation, and if you look right here, you're seeing some a double doji because price the same amount of wick to the upside was created and the same amount of wick to the downside was created, and then you have this bearish engulfing candlestick. So I can decide to hop on a short position here at the open of this new candlestick and set my stop loss just a little bit above the support level. Now, how do I get my take profit level? The same thing. I check the height from the highs to the lows of this rectangle chart pattern, and I just drag and drop. Or I can decide to use previous levels that market has touched. But let's see what happens. So market has hit our take profit level and it has gone like way below the take profit level. Now at this point, because market is trying to actually would have gone out of this trade in profit, but if you're looking to use high or massive take profit level or target levels, when you notice this kind of momentum, this kind of bearish momentum, it's indicating that you should go out of this trade, especially when you're using your moving average, which I'll talk about after. You see, so price has broken above the moving average. So if you're on this trade, this is a massive indication that you should leave this trade in minor profit. But yeah, we're going to move to indicators right about now, and I'm sure that this was easy and yeah, self-explanatory. So anybody has questions concerning the illustration that I just did right now? Okay, Messi Daniel says how will one know profit levels? Like I said, you're using the initial length from the highs and the lows of the chart pattern, or you can use, previous levels, support and resistance levels that market found it difficult to break, or market tested a lot of times. So we're going to talk about indicators, and indicators are mostly used to forecast price changes in the forex market. It's just like you have your traffic lights that is telling you, okay, red is for you to stop, yellow is to get ready, and green is to go. So that's just exact same thing that happens in the forex market with indicators. Now, they are calculations which take the volume and price of a certain financial instrument into account. Technical indicators can help you identify possible entry and exit points for trade. Now, we're going to talk about two common and popularly used indicators in the forex market. The first one we're going to look at is the moving average. And the moving average is simply a way to smooth out price fluctuations to help you distinguish between typical market noise and the actual trend direction. Moving averages are one most commonly used technical indicators. And one thing you should know about the moving average is that they don't predict the price direction. They define the current direction. We have two types of moving average. We have the simple moving average, which is the simplest type of moving average. They give us a broader view, and now with the simple moving average, you can gauge the general direction of market's future price. How do we calculate the simple moving average? The simple moving average is calculated by adding up the last n period's closing prices and then dividing that number by n. If this is a bit confusing, I'll just quickly put up an illustration. So let's say you have 5, 1, 2, 3, 4, and 5. And remember, the moving average is calculated by adding up the last n periods closing prices. So we have 5 candlesticks, right? So let's say we're using a 5-period moving average. So it's going to calculate the closing period of those 5 candlesticks and divide the number by 5, just like we have here. So let's say this candlestick closed at $1 and this one closed at $2, and 3, 4, and 5. So what the moving average is going to do is it's going to add up the total closing price, and if you do that, it should give you 3, 3, 6, 4, 15, and it's going to divide it by 1, 2, 3, 4, 5. So if you do this calculation, if you add 1 to 5 and divide it by 5, you should be having 3, right? So just put something like a dot right here. And now if the new price, if this candlestick continues in this uptrend and closes at $6, remember this is a 5-period moving average, so it's calculating only the closing price of the last 5 candlesticks. What's going to happen is it's going to start calculating from 2 to 6, so it's not going to calculate this one. And if you do this calculation, 2 plus 3, 9, 16. So if you do 2 plus 3 plus 4 plus 5 plus 6, you should be having 20, right? And then it's going to divide 20 by 5, because this is a 5-period moving average, right? It's going to divide it by 5, and if you divide 20 by 5, you're going to have 4. So if this candlestick keeps going up higher, the moving average is just going to connect the dots by the average closing time, right? I hope that makes sense if you don't understand moving average initially. Now we have 2 types of moving average, like I said, the simple moving average and the exponential moving average. The exponential moving average does pretty much the same thing, but it gives more weight to the most recent periods. If you look at this illustration, look at this. Yep, if you look at this illustration right here, you're going to see that, oh, okay, the red line indicates the exponential moving average, and the blue line indicates the simple moving average. Now this is a 30 period moving average, both of them, but you see that this exponential moving average is closer to the price than the simple moving average, right? It's more closer, it's catching, it's getting this high, it's getting this lows, it's closer, it's giving you or it's putting more emphasis on what traders are doing recently. And now the difference between the simple moving average and the exponential moving average is that the simple moving average is slower but smoother when responding to price action. The exponential moving average helps you to catch trends early, which will result in higher profit. But the downside of these moving averages is, for the simple moving average, you might get delayed too long and you might miss out on good entry because it's slower. But the exponential moving average has its own downside, which is you can get faked out when prices are consolidating. Now, if you've got questions on moving average, let me know in the comment section before I move to the second indicator, which is kind of like my favorite indicator. Someone is asking, how do you calculate PIP? If you check previous webinars on the OctaFX YouTube channel, you'd see fundamentals of trading. In that webinar, you can understand how you can calculate PIPs. Okay. All right, so we're going to talk about relative strength index, the RSI. If you're not new to trading, you must have heard about the RSI. And the relative strength index, or RSI, is a popular indicator that was developed by a technical analyst named John Wells Wilder. I don't know if I pronounced the name well, but yeah. It helps traders evaluate the strength of the current market, and the RSI helps in identifying overbought and oversold conditions in the market. A movement of 70 or higher indicates overbought conditions, and an increase in the possibility of price going down. Price movements around 30 or lower indicates oversold market conditions, and an increase in the possibility of price strengthening or going up. Let me quickly put up a chart. Okay, so concerning the moving average, how to use the moving average to identify the trend. For example, let's use the 200 moving average. Now, if you don't know how to add this moving average to your chart, if you look right up, you're going to see something like an FX sign. You'll see something that looks like an FX sign. Click on it and search for moving average. So you're adding any moving average that is under built-ins. I already have that added to my chart, so I wouldn't be adding it again. But for a downtrend, you can say that price is in a downtrend when it trades below the 200 moving average. And you can say that price is in an uptrend when it trades, if you look right here, price is trading, let's check for where price is trading above. This is still downtrend. Okay, right here, price is trading above the 200 moving average. So when it trades above the 200 moving average, it's in an uptrend, and when it trades below the 200 moving average, it's a downtrend. Now, this is an introduction to moving average. I'm not going to go over strategies you can use to trade, but subsequent webinars we're going to talk about strategies that you can use to trade with the moving average. And just like chart patterns, just like candlestick patterns, just like every other aspect of technical analysis, you're not trading this parts of technical analysis in isolation. So you don't trade indicators in isolation, you don't trade them alone by themselves, or you don't trade chart patterns by themselves. So we're going to talk about RSI. Let me just quickly add the RSI to chart, relative strength index. Yep. So from the definition, what it basically means is when price is at 70, you're looking to sell, and when price is at 70 or above, you're looking to sell, and when price is at 30 or below 30, you're looking to buy. Now, a lot of people say RSI doesn't work, and that's mostly because they trade the RSI in isolation, right? They just see that, okay, price is below 20, let me just buy, or price is below 30, let me just buy. That's not how it works, right? You don't trade these indicators in isolation. Now, for me, I love to put my overbought and oversold levels at 75 and 25 respectively. No much reason for that. It's just I'm just trying to give the market more room to get to me, to get oversold, or overbought, right? So let's say, for example, now at this point, right here, market is, if you look to the right, you're going to see this black indication around here that indicates the market was below 25. It was around 18.49. Now, when market is around these levels, you're looking to buy, but you don't just buy blindly, right? If okay, let me just add kind of like a chart pattern to this trade. Now, at this point, market was below 20, right? Novice trader can just decide to buy, but then if I look at the chart, I'm not seeing any chart pattern, so I might not have enough confidence to buy compared to when market comes below at this point, which is giving me something that looks exactly like a double bottom right there. I don't know if you're seeing what I'm saying, but I'm seeing a double bottom right here and here. Rejection, price couldn't break lower, and then started going up, right? And then you have the neckline. Don't forget that. Don't forget the neckline. It's very important. So now what I'm doing is I'm not just trading the RSI because price is low. I'm trading because I'm actually seeing a chart pattern in the market. So now I'm having enough confidence that, okay, market is looking to reverse, right? And then you have the breakout, and if you look closely, you'd see confirmation candlesticks. You can see this hammer right here indicates rejection to lower prices, and I can be looking to buy at that point. I can be looking to go long on that trade right there. Set my stop loss at the low. Oh. Yep, and then for the take profit levels, like I always say, when you're using the chart patterns, you're using the same height from the neckline for double bottoms or double top, from the left, from the neckline to either the support or the resistance level. I'm just going to quickly take that measurement real quick and kind of like apply it to the chart. And then, as you can see, price broke above it. Another way to get your take profit levels is to use previous levels that market has touched, like you have, or market has tested, like you have here. You also have that level around here. So you can see that price still tested those levels. Now, what just happened is I didn't trade the RSI because it's just low, it's at oversold level, so I'm just going to buy it. No, I added some chart patterns. I waited for some chart patterns to form, waited for the breakout, waited for a confirmation, and then I'll write in. So yep, that is an introduction to the RSI. There are different strategies you can use to trade the RSI other than this one I just did right now, but we're going to take everything one step at a time. And Right now, we're going to do like a recap on the content of the webinar today. We talked about technical analysis, what it's about, and and why it is important for you to understand technical analysis. We talked about chart patterns and the continuation and the reversal chart patterns and how to approach and trade these chart patterns. I also explained and gave examples of the reversal and the continuation chart patterns. Talked about indicators, and we did kind of like a basic definition and introduction to moving averages and relative strength index. So if you've got questions concerning content of today's webinar, I'm just going to take 4 minutes to answer those questions. Yeah. Trevor says, thank you for sharing this information. You're welcome. Okay. And yes, of course, this video is going to be available for you to watch and rewatch at your own convenient time for better understanding. And you can do well to also subscribe so you get notified whenever any of the indicators goes live, so you can get this quality information that we give out every day to help improve your trading abilities. Okay. Yes, Christopher, yes, you can draw these lines on your phones. The reason why I recommend PC is because you get to see it's wide and you get a long guide from far behind. You get a very wide historical data of the market. Okay, so no questions. I'll just have to round up at this point. But if you've got questions at any time, you can still drop them in the comment section. We'll talk about your questions or we'll answer your questions in the next webinar. All right.